welcome to the deep dive. Today we are going to go headfirst into some serious economic forecasting for 2025. You've given us a whole bunch of reports from some big names in finance, Wells Fargo, Invesco, BlackRock, you name it, we got it.
Yeah, and your goal is pretty clear. You want to know what these experts are predicting for the economy, where they see investment opportunities, and honestly, what it all means for you.
Exactly. And while we were digging through all this, we found some pretty surprising predictions. Like, did you know that some experts think a second Trump presidency might not actually cause like a huge oil boom?
Yeah, it's true. There's more to it than you might think at first glance. We'll get into that later. We also found that some experts are saying that inflation could cool down faster than most people expect.
And no economic deep dive in 2024 would be complete without talking about AI. We'll be exploring its potential impact not only on your investments, but even possibly your job.
It's definitely a force to be reckoned with. But first, let's start with the U.S. economy. It seems like everyone has a slightly different opinion about what we should expect.
Okay, let's unpack this. Wells Fargo seems to be cautiously optimistic. They predict growth, but with some pretty significant headwinds. They say tariffs are a big wild card. How could tariffs actually impact us in 2025?
Well, the thinking is that tariffs could lead to higher prices for consumers like you, which is basically inflation, and that could then slow down both the U.S. and global economies. The thing is, no one really knows how big of an impact tariffs will actually have. It's all very uncertain.
So it's like trying to plan your grocery budget when you have no idea how much food prices will go up.
Exactly. And on top of that, Wells Fargo thinks the Federal Reserve might not cut interest rates as much as people want, partly because of those inflation worries. They're also concerned that changes to immigration policy could slow down the labor force growth.
So tariffs, interest rates, immigration, a lot of unknowns swirling around, but there are some positives. Right. Wells Fargo predicts business investment, particularly in intellectual property, should remain strong. What does that actually mean for the average person?
Well, it tells us that the economy is changing, becoming more reliant on technology and innovation. If businesses are putting money into things like patents and software, it suggests they see growth in those areas. For you, this could mean new job opportunities in those sectors, or even new products and services that make your life easier or more efficient.
It's fascinating how these economic trends ultimately trickle down and impact our everyday lives. Okay, so we've got cautious optimism from Wells Fargo. What are other institutions saying about the U.S. economy?
Goldman Sachs is taking a much more bullish stance. They predict the U.S. economy will outperform other developed economies. They think things like tax cuts, deregulation, and government spending will really stimulate growth.
So they're betting on a more traditional pro-business approach to boost the economy.
Exactly. But even they admit there's a risk, a large across-the-board tariff. If that happens, it could really disrupt things.
It's like a game of economic Jenga. Yeah. One wrong move could topple everything. So we've got cautious optimism and we've got bullishness. What about HSBC and Barclays? Where do they stand on the U.S. economic outlook?
HSBC, similar to Goldman Sachs, sees the U.S. as a potential leader in the global economy. They think U.S. policies are setting the stage for growth in manufacturing and a renewed focus on American-made products. They also predict the U.S. will prioritize staying ahead in technology, which could mean a lot of investment in things like AI and robotics.
So HSBC is predicting an America-first economic strategy focusing on domestic growth and being a leader in technology. What about Barclays?
Barclays is a little more cautious. They acknowledge the uncertainty about whether the U.S. can actually keep up its current economic momentum. They also point out that the growing U.S. national debt could become a problem.
It's like when you keep using your credit card. Eventually, you have to pay it back.
That's a good way to think about it. So, you see, even when it comes to the U.S. economy, there's no one right answer. Each institution highlights different potential risks and opportunities.
It sounds like uncertainty is a theme here.
Yeah.
But I guess that's always the case when you're trying to predict the future.
Absolutely. And that uncertainty doesn't stop at the U.S. border. The global economic picture also looks a bit cloudy right now.
Wells Fargo seems to think that global economic growth will slow down, and they're pointing to those potential changes in U.S. trade policy as a big factor. They're also predicting that a lot of central banks around the world will try to stimulate their economies by making it easier to borrow money. Plus, they expect a stronger U.S. dollar, which can impact international trade.
Yeah, and Goldman Sachs has a similar view. They think U.S. trade policies could have a big impact on global growth, especially for countries that depend on trade a lot.
So if the U.S. starts putting up more trade barriers, it could have a ripple effect around the world.
Exactly. But Goldman Sachs also points out that some unexpected countries might benefit from this. As trade shifts away from China, some emerging markets could do well.
Interesting. It sounds like there could be some geopolitical winners and losers depending on how this all plays out. What about Barclays and HSBC? What do they think about global growth?
Barclays, as you might expect, is advising investors to be careful and to focus on companies that are likely to do well no matter what happens in the economy. They call these high-quality companies with defensive qualities. They also say to pay attention to how much debt governments have, as high debt can make countries more vulnerable to economic problems.
So they're saying don't put all your eggs in one basket.
Yes, diversification is key. And HSBC agrees. They also emphasize how important it is to carefully select investments, especially now with all this uncertainty.
So it sounds like these institutions are telling investors to be careful, choose investments carefully, and focus on quality and resilience. But in this kind of environment, where should people actually put their money?
Well, that's where the investment recommendations get really interesting. Each of these institutions has a different perspective on where the best opportunities are.
Okay, I'm all ears. What are these financial wizards saying?
Invesco thinks fixed income investments, which usually means bonds could still be a good option, but investors need to be careful not to overpay. They specifically say to look at bonds that are sensitive to interest rate changes and bonds from corporations.
So they're saying bonds can be a good investment, but you have to be picky about which ones you buy. What else are they suggesting?
They also see opportunities in real estate infrastructure projects like roads and bridges and private equity. These are all areas that can grow over the long term and are usually less affected by short-term changes in the stock market.
It sounds like they're looking for stability and steady growth.
Yeah.
What about BlackRock? What do they focus on?
BlackRock is all about something called thematic investing, which means investing in companies that are going to benefit from major long-term trends.
I like that. Investing with a story in mind. What trends are they focused on?
They're really interested in things like infrastructure manufacturing and housing. These are sectors that will likely see more demand as the global population grows and moves to cities. They're also big on AI and healthcare, driven by new technology and the fact that people are living longer.
So BlackRock is looking at where the world is headed and trying to invest accordingly. That's a forward-thinking approach. What about the other institutions? What are their investment strategies?
Goldman Sachs believes it's important to have a diverse portfolio, basically not putting all your money in one place. They recommend a mix of stocks, commodities like oil and gold, and bonds from developed countries.
So they're advocating for a balanced approach.
Exactly. They are a little cautious about the U.S. stock market, though. They think some U.S. stocks might be too expensive right now, which means there's a bigger chance of losing money.
That makes sense. If you buy something that's already expensive, it's less likely to go up in value. What about HSBC? What's their advice?
HSBC, like the others, says it's really important to choose investments carefully, especially in emerging markets. Those are countries with economies that are growing fast. They like bonds from India and Indonesia and think there are good opportunities in certain Chinese stocks. But they also recommend looking for companies that have strong potential to grow but aren't overpriced.
So not just going for the most popular stocks, but looking for quality and value. It seems like that's a common theme. What about Barclays? What's their investment philosophy?
Barclays suggests something they call a core satellite approach. It basically means you start with a solid base of safe investments, that's your core, and then you add smaller, more focused investments in areas that could grow a lot but are also riskier. Those are your satellites. This strategy helps balance risk and reward.
That makes sense. Having a strong foundation and then branching out into more specific areas. So with all these different investment recommendations, what's the main takeaway for our listeners?
The most important thing is that there's no one right answer. The best way to invest depends on your own goals, how much risk you're comfortable with, and how long you want to invest your money for.
It's all about finding what's right for you.
Exactly. Now, we've covered a lot, but we're not done. There's one more big topic: artificial intelligence.
Right, the AI revolution everyone's talking about. But is it all just hype, or is it really going to change things?
That's the big question, isn't it? And as you might guess, different institutions have different opinions about what AI can do.
Well, let's start with the people who are a little skeptical. What are they worried about when it comes to AI?
Barclays, for example, admits that there's a lot of excitement about AI, but they have some questions about what it can actually do in the real world. They point out that AI uses a lot of energy. We're talking about huge data centers with powerful computers that need electricity, and as AI becomes more common, we'll have to figure out how to produce enough energy to power it all.
I never thought about AI needing so much energy, but it makes sense. All that computing power has to come from somewhere.
Exactly. And Barclays also says that even though people are using AI quickly, Its ability to actually replace jobs and make us more productive is still in its early stages.
So maybe you don't have to worry about robots taking our jobs just yet.
Maybe. But even if AI doesn't cause a lot of unemployment, it will definitely change the way we work. And those changes could be both good and bad.
Definitely something to watch closely.
Yeah.
What about the more optimistic views on AI? Who's excited about what it can do?
HSBC is much more optimistic. They see AI as a powerful tool for economic growth and innovation, something that can create new industries, new jobs, and even solve some of the world's toughest problems.
So they see AI as an opportunity, not a threat.
Exactly. They believe AI is here to stay and that smart investors will find ways to benefit from its growth.
So we have different opinions again. Some see AI as something that could cause problems, while others see it as something that could really change things for the better. What should our listeners take away from all this?
I think the important thing is that AI is a powerful force that's not going away. It's going to impact our lives, our work, and how we invest. The challenge for us is to understand both what it can do and what its limits are, and then make smart choices.
Absolutely. And that's what this deep dive is all about, helping you understand the complicated and constantly changing world of economics. We've talked about the U.S. economy, global growth investment opportunities, and the rise of AI, but there's still more to explore.
That's right. In part 2, we'll look closer at some specific investment ideas and what's happening in different parts of the world. We'll also talk about how to understand all this information and make good investment decisions. Stay tuned.
Welcome back to our deep dive into what's coming in 2025 for the economy. We've already covered a lot, but we still have a lot to explore.
Right. We've talked about the big picture, the U.S. economy, global growth, and the impact of AI. So now let's take a closer look at what these reports say about specific regions, starting with Europe.
Okay, Europe? What's the outlook there? I'm guessing it's not as simple as just good or bad.
You're right. It's definitely more complicated than that. Invesco says that European central banks are trying to make it easier for people to borrow money to boost their economies. They're doing this because Europe's economic growth is pretty weak compared to the U.S.
So they're trying to jumpstart their economies by lowering interest rates.
Yeah, that's a good way to put it. But the problem is, Europe has some deep-rooted problems. Barclays points out that government debt in the Eurozone is a concern. A lot of countries like France, Germany, Italy, and Spain can't really spend much more government money because they already have a lot of debt.
So even if they wanted to spend more to help their economies, they might not be able to without causing even bigger problems in the future.
Exactly. It's a tough situation. And to make things even more complicated, HSBC says that Europe doesn't have a clear plan for its industries, which could make it hard for them to compete globally, especially when it comes to manufacturing.
So Europe's facing slow growth, high debt, and they're not as competitive globally.
It's a tough spot for sure. But even with all that, there might be some opportunities. HSBC notes that as interest rates go down, it could be a good time to invest in European real estate.
I can see why lower interest rates usually mean lower mortgage rates, which makes buying property more appealing.
Exactly. And Barclays suggests that investors might want to look at stocks of big companies in the UK. These companies are usually more stable and they often pay dividends, which is a portion of their profits given back to shareholders. It can provide a steady income.
So even in a region that's facing some economic challenges, there might still be good investment opportunities if you know where to look.
Absolutely. And that brings us to another important topic that comes up a lot in these reports, the changing world of global trade. As we talked about before, HSBC thinks that the U.S., Japan, China, and India are going to be the main players in manufacturing because of their strong industrial policies.
What about Europe? Where do they fit in with these changes?
Well, HSBC suggests that because Europe doesn't have a unified strategy for its industries, it could struggle to keep up in the global market.
So we could see a big shift in how trade works globally, with Asia and the U.S. becoming the centers of manufacturing.
It's definitely possible. And this shift could be good and bad for investors.
Can you give us some examples of what those opportunities and risks might be?
Sure. HSBC says investors should look at companies in the U.S. and Asia that are in a good position to benefit from these changes in trade. This could be companies in manufacturing, infrastructure development, or technology. But they also say to be more careful about European companies that rely heavily on global trade because they might face more competition.
So it's all about understanding how the global economy is changing and then adjusting your investments accordingly.
Exactly. And that's one of the things I find so interesting about these deep dives. It's not just about predicting the future, but understanding the forces that are shaping the future and figuring out how to navigate them.
I like that. It's about being proactive, not reactive when it comes to investing.
Exactly. Now, we've talked about regions and global trends, but what about specific investments? Where do these institutions see the most potential for growth?
Okay, let's get into the specifics. What are these financial experts recommending?
All right, remember, these are just suggestions, not guarantees. Invesco, like we talked about earlier, likes fixed income investments, especially bonds that change value with interest rates and bonds issued by companies. They also see potential in real estate infrastructure and private equity.
So they're mixing traditional investments like bonds with alternative investments that might have higher returns but also come with more risk.
That's a good way to put it. BlackRock, like we discussed, is all about thematic investing. They're looking at sectors that are in line with big long-term trends. They like infrastructure manufacturing, housing, AI, and healthcare.
They're playing the long game, investing in areas that will likely grow as the world changes.
Exactly. Goldman Sachs, while they say diversification is important, also sees potential in stocks, commodities, and bonds from developed countries. They believe the U.S. economy will stay strong, but they don't recommend putting too much money in U.S. stocks because some of them might be overpriced.
So a balanced approach is key.
Absolutely. And HSBC, like the others, stresses the importance of choosing investments wisely, especially in emerging markets. They recommend finding companies that are likely to grow a lot but are still reasonably priced.
So not just going for the most popular stocks, but looking for good value. It seems like that's something we've heard a lot. What about Barclays? What do they recommend?
Berkeley suggests focusing on high-quality companies that can do well even if the economy isn't doing so well. They think big companies in the UK have potential because they're stable and pay dividends. They also like certain types of corporate bonds that offer a higher yield or return.
So Barclays is recommending a mix of quality value and income. It's interesting how each institution has its own way of looking at things, but there are some common ideas in their recommendations.
That's a good observation. The common themes are to diversify, choose investments carefully, and make sure your investments match your goals and how much risk you're willing to take.
Absolutely. Now, before we move on, I want to go back to something you said before. You mentioned that HSBC thinks a second Trump presidency might not actually mean that the oil and gas industries will boom. Can you explain why that is?
You're right, that is interesting. Most people would probably think that Trump would be very supportive of oil and gas given his past policies. But Barclays warns that there are other things happening that could slow the industry's growth.
Like what?
Well, for one, the U.S. is already a big oil producer, so making even more oil might not be as easy or profitable as it used to be. There are also environmental concerns. Producing more oil and gas could make climate change worse, and that's something investors and politicians are thinking about more. Plus, there are infrastructure issues. The U.S. would need to invest a lot in things like pipelines to be able to handle a big increase in oil and gas production.
So it's not as simple as just producing more oil.
Not at all. And Goldman Sachs brings up another point. Trade wars. If Trump starts putting up more barriers to trade, it could actually hurt the global energy markets, making it harder for U.S. oil and gas companies to sell their products to other countries.
That's interesting. So policies that might seem like they would help the oil and gas industry could actually end up hurting it in the long run.
Exactly. It shows that even things that seem simple can have unexpected consequences. It also shows how important it is to think critically about how different political and economic decisions could play out.
It really highlights how complex everything is.
Absolutely. And we need to keep that complexity in mind when we're looking at these investment recommendations and thinking about our own financial plans.
Well said. I think this deep dive has given everyone a lot to think about. We've talked about the global economy, AI changes in trade-specific investments, and even how political decisions can impact certain industries. It's been quite a journey so far.
It really has. And even though we can't know for sure what the future holds, I think these insights from these big financial institutions can help us make smarter decisions and deal with the uncertainty that's ahead of us.
I agree. We're learning a lot and hopefully getting a little wiser. Now, before we wrap up this part, I want to hear your final thoughts. What's the most important message you want our listeners to take away from what we've talked about so far?
I think the most important thing to remember is that even though we've discussed a lot of uncertainty and potential risks, there are also reasons to be optimistic. The global economy is pretty resilient. New innovations are happening all the time, and there are a lot of opportunities for investors who are willing to do their research, be strategic, and stay informed.
That's a good positive message.
Yeah.
I think it's also important to remember that investing is a long-term thing. We shouldn't get too worried about the daily ups and downs of the market. We need to focus on our goals, be patient, and stick to our plans.
Great advice. And don't forget to diversify your investments, manage your risk, and get professional advice when you need it.
All great points. Well, I think that concludes part 2 of our deep dive into the economic outlook for 2025. But don't go anywhere yet. In part 3, we'll talk about some more investment ideas, dig even deeper into the AI revolution, and wrap up with some final thoughts on how to understand it all and navigate the year ahead. Stay with us. Welcome back to the final part of our deep dive into the economic outlook for 2025. We've covered a lot, but there's still some really interesting insights to unpack.
You're right. In this last part, we're going to explore some more investment themes, take a closer look at what the AI revolution really means, and offer some final thoughts on how to make sense of it all and be ready for whatever comes next.
Okay, let's get into it. One thing that caught my attention is private markets. HSBC seems really optimistic about this area, and they say that with interest rates going down, it could become even more attractive to investors. But I have to admit, private markets are not something I'm super familiar with. Can you tell us a little more about them and why investors might be interested?
Sure. So private markets basically mean investments in things that aren't traded publicly on the stock market. This includes things like private equity, real estate infrastructure, and private debt.
So it's a way for investors to get into different kinds of assets that aren't as affected by the ups and downs of the stock market.
Exactly. And HSBC thinks private markets have some advantages, like they could potentially give you higher returns than stocks and bonds that are traded publicly. And they can also help make your investments more diverse because they don't always move the same way as the stock market.
So higher returns and less connection to the stock market, that sounds pretty good. But I've heard that private market investments can be harder to sell quickly if you need the money. Is that something investors should be worried about?
It's something to think about for sure. Private market investments are generally harder to sell quickly, but sometimes that can actually be a good thing for investors who are in it for the long run. It kind of forces you to be more patient and not make rash decisions based on how the market is doing at any given moment.
I see what you mean. It's like the difference between a regular savings account and one of those CDs where you have to lock your money in for a while. Sometimes it's good to not be able to access your money immediately if you're planning for the long term.
That's a good comparison. Now let's talk about the AI revolution again. As we've discussed, AI has the power to change things in big ways, both good and bad. And one of the main questions for investors is how do you actually invest in something that's changing so quickly?
Right. AI is more than just a cool new technology. It has the potential to change entire industries and change how we live and work.
Exactly. And Barclays has some interesting thoughts about investing in AI. They say we need to look beyond all the hype and focus on how AI can actually be used. They highlight 3 areas where there's potential: AI essentials, AI enablers, and AI developers.
Yeah, that sounds interesting. Can you explain those categories a bit more and give us some examples?
Of course. So AI essentials are the companies that provide the basic building blocks for AI. These are the companies making the computer chips, building the data centers, and offering cloud computing services. Think of companies like NVIDIA, which makes those powerful chips used in AI, or Amazon Web Services, which provides cloud infrastructure for AI applications. These companies are like the foundation that the whole AI ecosystem is built on.
It makes sense that they would be so important for AI to grow. What about AI enablers? What do those companies do?
AI enablers are companies that use AI to make their current products and services better. For example, Salesforce is a company that offers customer relationship management software. They're adding AI to their platform to help businesses automate things, analyze customer data, and improve their sales. Another example is Adobe, which makes creative software. They're using AI to power features in things like Photoshop to make them smarter and easier to use.
So they're not necessarily creating new AI technology themselves, but they're using it in clever ways to improve what they already offer. That's smart. And what about AI developers?
AI developers are the ones on the cutting edge of AI innovation. They're creating the algorithms, the models, and the new AI technologies. This could include startups, research labs, and even some big tech companies like Google and Microsoft who are putting a lot of money into AI research and development.
So if you want to invest directly in AI developers, might be a good option, although it's probably riskier, right?
That's a good point. AI is still pretty new, and there's no way to know for sure which companies or technologies will be successful. Barclays says investors need to be patient, choose carefully, and be ready for some ups and downs in the AI world.
It sounds like investing in AI is a bit like exploring a jungle. You need a good map, a sharp tool, and the courage to make your own path.
I like that analogy. Now, we've talked about a lot of investment themes and opportunities, but before we finish this deep dive, I want to talk a little bit more broadly about how to think about investing in a world that's so complex and unpredictable.
I'm listening. I think that's exactly what I need right now. A way to understand all this information and figure out what to do next.
One of the key takeaways from all these reports is that We can't really know what's going to happen in the future. No one can say for sure what the markets or the economy will do.
It definitely feels like that.
Yeah.
There's always some new surprise coming up.
That's true. But instead of letting the uncertainty stop us, I think we need to embrace it. We can use it as a chance to learn, to adapt, and to grow. And that brings us to another important idea: critical thinking.
Critical thinking
Yeah.
when it comes to investing.
Yes, absolutely. We live in a world where there's so much information, and sometimes it's even contradictory. So it's more important than ever to be able to think critically about what we read, what we hear, and what we see. We need to question things, consider different points of view, and really weigh the evidence before we make decisions.
I can see how that's important for investing. It's easy to get caught up in the excitement or let your emotions make decisions for you, but that's usually not a good idea.
Exactly, and that's one reason why I think these deep dives are so valuable. They give you a curated set of insights from different experts, which encourages you to think for yourself and come to your own conclusions.
I agree. It's like having a team of analysts helping you figure out what's important and what's not.
I like that. These deep dives make us think differently, introduce us to new ideas, and ultimately help us make better decisions.
This has been such an insightful journey. We've looked at the global economic picture, explored specific investment ideas, and even thought about the future of AI. I feel a lot more prepared to deal with whatever 2025 and beyond throws at us.
That's great to hear. Remember, the most important thing is to stay engaged, keep learning, and never stop asking questions.
Absolutely. Well, I think that brings our deep dive into the economic outlook for 2025 to a close. Thank you for joining us on this journey. We hope you found it helpful and informative.
It's been my pleasure. And remember, even though we can't know exactly what the future holds, we can approach it with knowledge, curiosity, and a healthy dose of critical thinking.
Until next time, happy investing.